here again for a monthly update. And this month you have the dubious pleasure of seeing myself and Mike on screen. So apologies for that. Mike, good to see you, and thanks for joining as ever.
Yeah, good.
We've got an interesting time ahead of us with the US elections really heating up. What have you been looking at?
We're coming into a really crucial period, just to understate matters. So as it stands at the time of speaking, Biden is well ahead in some states and in some national polls, maybe 10 points ahead of Trump. And the market reaction, I think, supports that, in that equities are rallying allegedly on the sense that a Biden victory means you won't have or the size of the Biden lead in polls means you won't have a contested election. And also individual Democrats are polling well against Republicans, even in some of the southern states. And I would probably caution a little bit, because the political pendulum in the states has swung one way or to one extreme with Trump in terms of where taxes and regulation are, and they will swing back the other way. So I think once we get over the sense that we have certainty and I think calm, maybe for the next 3 or 4 years, or a lack of noise in politics, then I think the market will begin to price in some of the more maybe redistributive policies of a Biden administration. But for now, in the short term, it's risk on. And just maybe to shift gears a bit to the bond markets. Again, we've had a period of super low interest rates. Italian bond yields, for example, hitting multi-century lows. I've looked at a chart going back 700 years, and we have the lowest Italian bond yields in all time. What's your reading across the international bond markets?
So I guess I'm not the only one that's read A History of Interest Rates. Fascinating reading. I think certainly if you look past over the past couple of months, we've hardly seen government bond yields shifting. And even when we go to the corporate bond markets, where you tend to see a bit more volatility, the actions of the Federal Reserve really seem to have calmed things down. We saw this at the end of March when they came in and started intervening. First in the investment grade market, and then of course they moved on to the high yield market as well. And it's really difficult for bond fund managers at present, I think, to really create any value, because you're not earning any carry, because yield is so low, the income produced by bonds is minimal. And there's not much opportunity to pick up capital return from bonds as well, because prices aren't moving around, because there's no volatility. So, it's supportive for equity prices in a way, because yields being low pushes people out along the risk curve into equities. But it's not great news if you're a bond fund manager, because there's not much value to add, I'm afraid. Maybe, we could see a move in bond yields if there's more stimulus measures and those are seen as inflationary. But I don't think the latest update on possible stimulus was actually that conclusive. Did you see this?
Yeah, so I think there is this argument lurking behind the bond markets that a decisive fiscal stimulus, particularly in the States, might ignite a debate on, inflation. Will we get inflation into the future? So in the States, the debate about a stimulus has been dragging on for some time now, and I think is running into a time limit, in the sense that senators will want to get back to their own states to campaign. My own sense is that if we finally get a stimulus bill, it will be much more limited than the one we had in the immediate past of the coronavirus, and it may be enough just to tide individuals and businesses over towards the end of the year. So I'm not massively optimistic in terms of where US growth is going to go maybe in the next 2 quarters. I think we're just maybe fomenting something deeper. One area I think I am optimistic on is China. A lot of the numbers coming out of China are really beginning to pick up. And I think that's one positive area just to keep focused on in terms of the economy. And then in other monetary jurisdictions, central banks are looking to be even more ambitious. And of course, we have this conversation in the UK about negative rates. Do you think that will work?
I think the first thing to reference is that there's a news story out yesterday that says the Bank of England has written to a number of UK banks saying, are you prepared and set up for the possibility of negative interest rates? Could your systems actually handle it? Which suggests that they are a step closer to trying this. In terms of whether they would work, I'm not really sure. I think if you look at what happened in Europe with negative interest rates, and to an extent Japan as well with their very low rates, you can see how it really hurts the banking sector. Mm-hmm. And this probably explains why UK banks are not quite as low as they were in 2008 in the financial crisis in terms of share prices, but they're heading in that direction again. And a healthy banking sector is really important for the economy. I'm not sure it's a great idea myself. We might see the impact in the currency markets. That might be the outlet. We might see people just shun the pound even more. And it's difficult because we also have Brexit coming up again, and the October 15th deadline is just a couple of days away at the time of recording. So we'll have to figure out what impact the potential negative interest rates is having, as well as the Brexit negotiations. There's going to be a lot to analyse, but to answer your question, I'm not that keen on negative.
I tend to agree, and I think there's been some work done in the Fed and in the US as well. I suppose intellectually just cutting this policy avenue off as a way for the Fed to go. And just finally, we've discussed a lot some of the themes in our idiosyncratic portfolios. Two that are quite timely and apt are in healthcare. One, I think, in healthcare transformation, the other healthcare innovation. Maybe we finish with just a quick update on those.
Yeah, it's interesting to look at some of the themes that our clients hold. And healthcare obviously is one that's been in the news this year, shall we say. And we have two ETFs. So one, as you mentioned, is broad healthcare exposure. So that's got the big names in there, the AstraZenecas of the world, etc. And over the past year, that's up about 20% in terms of total return. Now, the other one is almost this junction of two themes, because you've got healthcare and you've got technology. And this is the healthcare innovation ETF. And that one over the past year was up about 53%. It's really combined two very popular narratives for investors and really been one of the strongest performing themes that we have, or clients have in their portfolios. And now these obviously are held on an execution only basis. So, this is not a recommendation. It's just an interesting observation on the difference in performance between two healthcare focused ETFs when you get that extra kicker of having technology and innovation added into the mix.
Okay, that's an optimistic note, I think, to finish on. I think next year, hopefully, we'll be over COVID. And I think many people are actually beginning to think of next year as a year of optimism and innovation. So that's quite a good way to finish on. And I guess the next time we speak again, Daniel, we will know who the next president is and how the market's going to react to that.
Hopefully so. Hopefully they won't be arguing about the result.
Yeah.
Yeah. Thank you, Mike.
Okay, good. Thanks very much.